Hey everyone, welcome to the Ashworth Wealth Market Update. Wanted to spend some time today talking about inflation data, jobs creation data, as well as what might happen with the Fed next week. Now, of course, we don't really know. We're not big into prognostications here, but there are some things that we should at least be aware of as we go into the Fed rate cut decision next week. So let's just get right into the chart that we wanted to review this week. Um, so over the past few months, we've definitely had a cooling in the job market. So in May, we had pretty solid job growth, but it was definitely slowing. The CPI was a little bit soft, so it seemed like inflation was continuing to come down. In June, the jobs market or the jobs created beat expectations, but then in July it was revised significantly downward. And then in August, it was pretty weak. We only had 22,000 jobs added last month, and they revised 27,000 off of the July numbers. So we do have a weaker labor market going on right now. At the same time, CPI is coming in hotter than expected. So it's about 3.1% in August, where the Fed's target is about 2. So we're still quite a bit above that. So all of that kind of puts puts some pressure on the Fed. They have to figure out what exactly to do. Um, in August, the unemployment rate was 4.3%. That is the highest since the pandemic, but it's still relatively low. I mean, the 50-year average is about 6.1%. As I said before, CPI is about 3.1%. Um, higher than the 2% target that the Fed typically sets. So there's some indicators pushing the Fed towards a rate cut. There's others that are saying no, it should stay kind of where it is because of where inflation is at. There's other things to consider. There is revenue coming in from all of the tariffs, as well as stimulus that's out there from the one big beautiful bill. So there's a whole bunch of things that the Fed really has to consider. Among all of this, we're sitting at all-time highs in the stock markets, and things are just kind of moving along from a stock market perspective. It's been great for all of our portfolios and for growth, but it is a little tricky to figure out where it goes from here. Now, luckily, you've heard me say this a million times, same thing out of Scott and Todd. We don't necessarily care. We pay attention to this stuff so that we know what's going on around us, but we rarely will make decisions in our with our clients' money and based on portfolios or our portfolios based on the noise that's happening at any one given time. In the long run, a globally diversified portfolio wins, and that's one of the things that the information that we pulled for this webinar talks about. There's not a lot of margin for error right now with the Fed. If they drop rates, they run the risk of inflation going higher. If they leave it where it is, they run the risk of not helping the job market. So they don't have a very strong margin for error right now, a very large margin for error. But in the long run, it doesn't really matter all that much. The longer that we hold a globally diversified portfolio, the better off we are. Right now, Europe is doing really, really well. And so our investments that we have across the seas are doing really, really well. The US markets are still handling things. Like I said, we're at all-time highs. So as far as where we go from here, um, it's hard to say. The Fed has a decision to make. I'm not about to prognosticate what they are actually going to do. If they do cut rates, it's logical to think that the stock market is going to celebrate that a little bit with a little bit of growth. But I would think that most of it is already priced in at this point. The bottom line is that we need to build portfolios that are diversified globally so that they are resilient to the ups and downs of any one economy. And that's where we're at right now. By having a globally diversified portfolio, we do have the ability to move money as needed to take advantage of ups in the market as well as to take advantage of downs in the market. And that's where things sit right now. So as of today, we're just kind of waiting to see what the Fed decides to do next week. But long term, it's not really affecting anything that we do from a portfolio management standpoint. Um, all of that being said, it's been a good year. It was a little nerve-wracking, of course, for most of us in April when the tariffs really started to come into play and the stock market took a pretty serious downward turn. But all of you can look at your portfolios now and realize that by staying the course, we've ended up just fine on a year-to-date standpoint. So if you have any questions or concerns, please let us know. Happy to schedule a time if you're not already scheduled for a review this fall. Please let us know. Happy to schedule a time to meet with you or any of your family, friends, anybody that you think could benefit from the information that we share. So we'll see what the Fed does next week, and when their meeting is scheduled, and then I'm sure we'll have another update for you based on that information. So up to that point, hope everybody's doing really, really well, and we'll be in touch soon. Thank you again for being able to work with you. We really do appreciate all of our clients. Have a great day. Bye.